In this video, we will discuss short-term and long-term finance. We will identify their definitions and give some examples. So without further ado, let's begin. First, we will begin with short-term finance. Short-term finance refers to money borrowed or raised for a period of less than 12 months. It's mainly used to cover day-to-day expenses and is also known as working capital. Examples of short-term finance include overdrafts, which is borrowing from the bank to cover temporary cash shortages, trade credit, when suppliers allow payment to be delayed, and short-term loans, quick borrowing that must be repaid within a year. The main advantage is flexibility, but the disadvantage is that it can be expensive and must be repaid quickly. Next, we move on to long-term finance. Long-term finance is money borrowed or raised for a period of over 12 months, often several years. It's usually used to fund big investments such as buying property, machinery, or expansion projects. Some examples include share capital, which is selling shares in the business to raise money, long-term loans or mortgages, borrowing over a longer period with regular payments, or retained profit, in reinvesting profits back into the business instead of paying them out. The main advantage is that large sums can be raised for growth, but the downside is long-term commitment and possible loss of control if shares are sold. In summary, short-term finance is best for immediate temporary needs, while long-term finance is suited for major investments and expansion. A good business will often use a mixture of both depending on its needs.